my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London UK feed wheat. Paris milling wheat. After the market created a cusp back in late May, we had a resultant break higher, something I had cautioned about back then, and prices rose and fell through stratified layers of support and resistance. Some of them seemed and still seem quite dense, such as the congestion area overhead resistance that we sit just underneath between 238 to 242, containing the March 2013 high at 240, the flatlining short medium moving average currently 240 also, and the flatlining medium moving average currently at 242. Above this is the February 2013 resistance at 247, and at the same level of 247 now is the declining long moving average. The market pushed down through this 238 to 242 congestion a few times, most recently in mid-October and then more severely from late October till this week, when the outlying support of the September 2021 low at 234, which had managed to hold up prices at the extreme, more or less, since late June, gave way and we made new lows not seen since early June. As part of this move lower, I would like to discuss some previously mentioned big picture items. Firstly, this market is still well within the big bear channel, currently 183 to 259, highlighted in dark blue on my daily chart, and originating from the October 2022, well over a year ago. Secondly, I've highlighted the more recent action in greater depth over the past few weeks, especially since early September, and I originally saw the opportunity for a possible sideways triangle, with the upper trend line currently at 241, originally just above the medium moving average, currently at 242, but now partnered with it, if a little below right now. This is highlighted in bright red on my daily chart. But what is more, I have also changed its shape, though not its nature. It is still a triangle, but now a descending triangle, currently 234 to 241. This week has been very special for this pattern, as we have had a break lower, below the lower bright red trend line. At the moment, it may still be regarded as a breach, but I feel it appropriate to lay out some targets below for such a pattern. Thus, a primary target X will be in the 227 zone, just around the next congestion below, whilst a harder to reach secondary target X1 would be in the 220 zone, just underneath the May 23 low. Finally, this also came from my close studying of the recent action, so look at the action around the 11th of October as a bow tie formation of the moving averages, specifically the short moving average currently at 236, the short medium moving average and the medium moving average. Now, though it was and is a fairly flat as a bow tie, in that the moving averages went in the pattern in the right order but came out a bit sloppy, with the medium moving average initially rising and the short moving average and short medium moving average earlier intertwined, it nevertheless is a genuine bow tie formation. So what does this mean? Well, the theory behind bow tie formations is that the market will move in the general direction of the moving averages as they exit the bow tie, which was mainly downwards, which has sort of happened. Additionally, between 15 to 20 sessions after the crossover, we should see a move in prices in the direction of the bow ties, that is lower. So, in that case, it would be between approximately the 1st and 8th of November. Well, we really didn't see any significant move lower, though on Monday the 6th we did try lower. However, I am partially satisfied, as during this window I did change the original sideways triangle into a descending triangle. We have seen an attempt lower since. So perhaps a delayed response? Well, a delayed response is being kind to the market about this bow tie formation. We'll still have to wait and see. London UK feed wheat. The move higher from the May to July double bottom pattern, which reached its climax in mid to late July with a combination of an island top, was also part of a small double top, an Adam and Eve type. Well, since then prices have moved lower. The short medium moving average, currently at 187.15, has tried, not wholly successfully, to act as a sort of cap on any rises, and the medium moving average, currently at 190 even, has moved from being an attractor to being a cap in recent tries higher. Interestingly, one of the key recent features here, and this is a surprising feature, has been the neckline, highlighted in dark blue of my daily chart, currently at 184.30, of the May to June reverse head and shoulders bottom, acting as a pretty reasonable support. Though I suspect in the background the September 2021 low at 181.70, but more importantly the 50% absolute Fibonacci line at 180.5, have helped in the past to prop up prices. This situation, I suspect, is not designed to last, as coming in from above, we have the declining long moving average currently at 193.80, dropping down to no doubt try and pressure prices lower. You can see the effect it had back in late July, capping the market with a small double top. It is not long now till the long moving average drops into the frame, so I would keep a close eye on it, as the room for maneuver of this market is becoming quite restricted. In the bigger picture, there is currently no significant pattern development being undertaken apart from the neckline, which I suppose is a little disappointing and at the same time unsurprising. In the meantime, the market seems reasonably happy to travel slightly higher along and on top of the neckline and towards a greater bearish pressure that is coming soon from the declining long moving average. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.